Welcome back to Investing Talk Podcast.
So today I want to talk about the, let's call it the unsexy side of the AI revolution.
Okay.
We're tearing up the floorboards, we're looking at the plumbing, and I don't mean, pipes in your basement.
Right. Not literal plugs.
No, I'm talking about the critical kind of invisible infrastructure that makes the entire generative AI boom even possible. We're looking at Credo Technology Group, ticker CRDO.
Plumbing is usually the boring part of the house. But when I look at these numbers, boring is definitely the wrong word. Explosive feels a bit more accurate.
Boring is absolutely the wrong word. I mean, think of Credo as the nervous system for these huge hyperscale data centers. Everyone loves to talk about the brain, the GPUs, the NVIDIA chips, all the processors. But if you can't move that data fast enough between the neurons, that brain is useless.
And that's where Credo comes in.
That's where they come in. And just to give you a taste of why we're so focused on them today, their revenue trajectory is up over 200% year over year.
That's a massive number.
Yeah.
I mean, usually when you talk infrastructure plays, you're looking for steady, almost utility-like returns. This is a rocket ship.
It's staggering. And this isn't just another chip play, it's a pure connectivity play. They're solving what is probably the single biggest bottleneck in AI right now.
Which is what?
Input-output speed versus how much power you're consuming.
Okay. As usual, before we start, subscribe, like, and comment to this video to support the show. It really, really helps us out with the algorithm and lets us keep these deep dives coming.
So are you ready to see if this plumbing is made of gold?
I'm ready to see if the valuation holds water or if it's just going to leak everywhere. Let's get into the numbers.
All right, let's start with the explosion. And I do mean explosion. Credo just put out their Q2 fiscal year 2026 revenue. They brought in $268 million.
Okay, $268 million. Let's put some context on that because for a lot of companies, that's just a rounding error. But for Credo, that's a defining moment.
Yeah. Context is absolutely key here. That number is up 20.2% sequentially so just from the last quarter.
Wow.
And a massive 272.1% year over year.
272%. That's just rare. Even in high growth tech,
Yeah.
You see 40, maybe 50%, and Wall Street goes crazy.
Right.
Triple digits is an anomaly. That means the business has fundamentally changed in just 12 months.
Exactly. And they didn't just grow, they crushed expectations. Analyst estimates were sitting around, what, $235 million?
Yeah, about that.
Credo blew right past that by over $30 million. They didn't just beat the target, they completely lapped it. But here's the kicker, and this is what has growth investors just salivating. It's the guidance.
The promise of what's next. And usually, you have a blowout quarter, management tries to temper expectations a bit.
Of course. Lower the bar.
Yeah, those sandbags so they can jump over it again.
Not here. They pre-announced their Q3 revenue, somewhere between $404 and $408 million.
Whoa, hold on. Let me just run that math. They just did 268, which was a record. And now they're guiding for over $400 million next quarter?
Yep.
That's almost a 50% jump. Sequentially. Not year over year, that's quarter over quarter.
Yes. The prior guidance was around 335. The analyst consensus was 341. So they're just rewriting the entire story here. They're basically telling the market, we are accelerating faster than you can even model.
So they're on track for over 200% growth for the full fiscal year.
That's the takeaway.
Okay, those are flashy headlines, and they're great. But you know me, I like to see what's left over after the party's over. Let's talk profitability. Because a lot of times, a company growing at 200% is just burning cash to buy that revenue. Is that happening here?
That's a fair point. But Credo seems to be defying gravity on that front, too.
Okay, looking at the earnings here, Q2 EPS, earnings per share, came in at 67 cents.
And the estimate was 49 cents.
So a beat by 18 cents. That's a significant beat on the bottom line. Net margins are sitting at a very healthy 26.6%.
Which is respectable.
For a hardware company in hyper-growth mode, bringing more than a quarter of every dollar to the bottom line it's very respectable.
It is. But I want you to look a little higher up on the income statement. Look at the gross margins.
Let's see. 67%.
67%.
That's software territory.
Yeah.
Hardware is usually in the 40s, maybe 50s. If you're making widgets, you have material costs. 67% tells me they're selling something with incredibly high value.
That is the magic number for me. When you have gross margins that high, it signals two things. One, your product is highly differentiated, so you have pricing power. You aren't in some commodity war.
Right. No race to the bottom on price.
And two, and this is critical, it gives them a massive war chest to just pour back into R&D.
Which they have to do. Because in the semiconductor space, if you stop innovating for 6 months, you're dead. You get designed out of the next server rack.
Exactly. And that brings us to their competitive mode. Why are the margins so high? What are they selling that commands that kind of premium?
Okay, let's hear it.
It's proprietary IP for high-speed connectivity, specifically their active electrical cables, or AECs.
Let's unpack that. Active electrical cable sounds a little like marketing jargon. I mean, why does a cable need to be active? Why not just use a copper wire?
That's a great question, and this is really the core insight for today. Think of data moving through a copper wire like a voice shouting down a hallway.
Okay, I can picture that.
In the old days, at lower speeds, it was like a short, quiet hallway. The message got there just fine.
Simple enough.
But with AI workloads, the data speeds are just insane. We're talking 112 moving to 224 gigabits per second. At those speeds, the physics of copper wire, it starts to fight you. The signal just degrades almost instantly.
So the voice turns into static. You shout, hello, and the other end just hears, jit-to-to-do.
Exactly. So for a while, the alternative was optical cables, using light.
Right, fiber optics.
Optical is super fast and goes long distances, but it needs lasers to convert electricity to light and back again. And lasers are expensive, they run hot, and they are power hungry.
And power is the #1 constraint in a data center right now. Every watt you spend moving data is a watt you can't spend computing it.
Precisely. This is where Credo found the Holy Grail. Their AECs are copper cables, but they have a tiny little silicon chip embedded in the connector at each end. That's the active part. That chip cleans up the signal, it boosts it, and it lets the data travel fast over thin, cheap copper wires without that massive power drain of optics.
So it's a hybrid. It uses the cheap material of copper, but it uses silicon to trick physics into thinking the wire is better than it is.
That is the perfect way to describe it. It's the perfect middle ground. It's cheaper than optics, uses about 50% less power, but performs way better than just a standard copper cable.
So they found this huge niche between the cheap stuff that doesn't work anymore and the expensive stuff that uses too much power.
It's a massive niche. It's becoming the standard for connecting servers inside the rack. When you see a picture of a massive NVIDIA server, all those cables plugging everything together.
Those are increasingly AECs.
Yep. And they have a new product that's really driving this, the Blue Heron 224G retimer.
Blue Heron. Sounds elegant. What's a retimer? Is that different from the cable?
It is. A retimer is like a little pit stop for the data on the motherboard itself. As the signal travels, it gets tired and distorted. It picks up jitter.
Okay.
A retimer catches that weak signal, completely regenerates it, makes it crisp and clean again, and then sends it on its way.
So it's like a relay racer grabbing the baton.
Yeah, but a relay racer who takes a tired, stumbling runner and instantly swaps them for a fresh Olympic sprinter. The Blue Heron helps with the physical limits of these new, dense server racks.
Okay, so it sounds like they're selling the shovels in a gold rush, but like specifically the shovels that don't break.
That's a good way to put it.
Let's check the financial health, though. Market cap is at $22.29 billion. This isn't a small company anymore.
No, it's a serious mid-cap player.
No significant debt mentioned, which is great. Clean balance sheet, return on equity is strong, 25.28%.
Very efficient use of their capital.
However, I do have one little nitpick.
Yeah.
The free cash flow details. They weren't really broken out in the recent highlights. And when companies are growing at 200%, cash flow can get messy. You're buying tons of inventory before you get paid. You can actually grow broke.
That's true. It's a valid concern. But with revenue accelerating this fast and those 67% gross margins, I'd argue they're reinvesting every single penny into inventory just to meet the demand.
So you're saying hoarding cash would be a bad sign?
I'd be worried if they were. The demand is right now. If they can't ship the cables because they didn't order the copper, somebody else will.
Fair. But I still want to see that audited cash flow statement. All right, let's pivot to the charts. Let's see how the market is actually treating this story.
It's been volatile, hasn't it?
Volatile is being polite. The stock just surged 10.8% to around $123.
Right.
This wasn't a quiet move. It was on volume of over 8 million shares, which is 17% higher than the average.
That just screams institutional conviction to me. That's not retail investors moving that kind of volume. That's the big funds stepping in.
It's definitely a breakout move from the prior close around 111.
Yeah.
But putting my skeptic hat back on.
Of course.
Despite that surge, the stock is still trading below its 50-day moving average of around 144 and the 200-day, which is at 142.
So we're still in a bit of a recovery phase, technically.
We're in a downtrend that's trying to reverse. When the price is below those key averages, they act as resistance, like a ceiling. The stock has to punch through 142 and 144 to really prove the bulls are back in control.
It's trying to break through the floor.
Exactly. It could go up, hit that ceiling, and get slapped right back down.
But you can't ignore the momentum from this revenue news. I mean, a 272% growth number it's a game changer.
The momentum is there, but so is the risk. The beta is 2.65.
Okay, explain beta for listeners who might not track that.
Beta measures volatility. The S&P 500 has a beta of 1. A stock with a beta of 2.65 means it's significantly more volatile. If the market goes down 1%, Credo could easily go down 2.6, maybe 3%.
But on the flip side, if the market rips higher...
Credo rips harder. It's a high-octane ride. You have to have the stomach for it.
I just look at that after-hours rally and the volume, and I see flow. I see big funds realizing they're underweight on connectivity and just rushing to get exposure.
So what's the market thinking broadly? Let's check the sentiment, because analysts must be divided on this.
Oh, they are definitely paying attention. You've got Needham. They have a buy rating with a price target of $220.
Wow. That's ambitious. That's almost double the current price.
They named Credo a top pick for 2026. Their whole thesis is based on the adoption of these AECs. They think AECs are going to eat up a huge chunk of the market that everyone assumed would go to optics.
And on the other hand,
you have Rosenblatt. They're staying neutral with a $170 price target. Still upside, but, much more cautious.
And the news headlines are a battleground too, I'm guessing.
Definitely. You see the bullish stuff like the market has given a chance to load up or strong buy on growth. But then
you get the bearish side. I saw one that was AI and Credo Technologies copper cables are breaking up.
Very dramatic.
It is. But the argument there is that maybe copper can't handle the next generation of speed. Sure, 224G works on copper now, but what about 400G?
Yeah.
800G. The bear case is that eventually physics just wins.
And optics takes over everything.
If that happens sooner than expected, Credo's moat just evaporates.
And I think that's the core debate, copper versus optics. But for right now, for the distances inside the server rack, a couple of meters, Credo's copper is winning on power and on cost. And in this economy, power and cost are king.
Here is the red flag I have to wave, though. Insider activity.
I knew you were going to bring this up.
I have to. Insiders sold almost 918,000 shares last quarter. That's $136 million worth of stock. And it was the CTO who reduced his position.
But he still holds over 6 million shares, though, right?
He does. But the question is still there. If the future is so bright, if we're going to $220, why are the people running the tech selling $136 million worth of it now? Why not wait?
Look, executives sell for all kinds of reasons. Diversification, buying a house, taxes. You can't always read it as a lack of faith.
Maybe.
I'm looking at the institutional accumulation. You don't get a $20 billion valuation and a 44% return over the last year without big money buying in. The market is absorbing those sales. The buyers are hungrier than the sellers.
It's a data point, that's all. So what's the next catalyst? What's the date we should circle on the calendar?
March 2nd. 2026. That's the full Q3 earnings call.
Coming up fast.
We already have the preliminary revenue, that 400 million number, but we need the details. We need the Q4 guidance.
Right. And updates on that 3M patent license.
Exactly. Yeah. That's high margin, zero inventory revenue. It means a giant like 3M is saying we need Credo's IP. It validates the whole technology.
Okay. Let's execute a deep dive into the risks. Let's just crystallize the bear case here. If this all goes wrong, how does it go wrong? 1. Technology risk. The optical interconnect threat. If a competitor like Marvell or Broadcom figures out how to make optical chips way cheaper and lower power, Credo's advantage just evaporates.
That's the existential risk. That's why that R&D spend is so critical. They have to keep pushing that copper curtain back.
2. Execution and auditing. These Q3 numbers are great, but they are preliminary. They're unaudited. It's rare, but sometimes final numbers look different.
A fair caution.
And finally, market risk. That high beta. If the big hyperscalers, Microsoft, Google paused their AI spending for even 1 quarter,
Credo catches a cold.
and it will fall faster and harder than the rest of the market because of that beta. And that insider selling is still a psychological hurdle. It puts that little seed of doubt in your mind.
Okay, the risks are real. The tech landscape shifts fast, but you have to weigh them against the opportunities. So, time for the verdict.
All right, laid out.
I've crunched the numbers, looked at the growth, considered the risks. My bullish score for Credo Technology Group is a 9 out of 10.
A 9. That is high praise from you. You usually cap out at an 8 on hardware plays.
It is high. But here's the thesis. Credo is absolutely crushing AI connectivity demand. We aren't guessing if they'll grow. They just told us they're growing 200%. The Blue Heron product cycle has legs. And those 67% margins give them the cash to defend their turf.
It's hard to argue with 200% growth and 67% margins. Usually you have to pick one or the other.
Exactly. So at around $123 a share, with analysts targeting $220, this stock feels like a coiled spring. It's pulled back, it's consolidating, and now it has this massive fundamental catalyst.
So this isn't a quick trade for you.
No, this is a multi-year hold into the fiscal 2027 AI cycle. We are still in the early innings of building out these data centers. Credo is the plumbing, and you can't build the house without the plumbing.
I'm inclined to agree, despite my concerns about insider selling. That revenue acceleration is just too strong to ignore. If they hit that $400 million next quarter, the stock will likely re-rate higher.
The market will have to accept they're a major player. The plumbing is turning into gold.
That's the thesis.
Yeah.
Don't forget to subscribe, like, and comment. We'll see you in the next one.